Welcome back. You're watching NDTV and we have our special show, Manage Your Money. This is the show where we answer all your questions about savings and investments. Cash is no longer king. Interest rates are falling and stock markets remain volatile. In such a situation, how should you tweak or build your portfolio? Over the next 30 minutes, our experts will help piece together the investment puzzle. Let's welcome in our guests. We have a noted financial planner, Harsh Roongta, joining us now. He is investment advisor and founder at harshroongta.com. Thank you so much for being with us, Mr. Roongta. Let's get started with the queries. We have got an email coming in from Prem Sai Patro. He's 33 years old. Now, his question is, I have a few ongoing SIPs which he started about a year ago, but unfortunately the returns are not noticeable. Please suggest some mutual funds or other investment avenues which will give good returns. Now, his savings are about 40,000 rupees a month and he wants to deploy them. Mr. Roongta, is this the right approach to an SIP method of investing in mutual funds?
So I think Prem Sai is making a mistake that a lot of investors end up making. So they've heard that equity markets are volatile and therefore to do investments in the equity market safely, it is better to invest systematically through as a SIP plan in an equity mutual fund. And I think they misunderstand the meaning of safety. Moment they are told that SIP is a safer method of investing in equity, in their minds the image that they conjure up is that this investment will give steady returns year after year. Just like if they were to invest in an FD, every year they would see a small little increment on the value of their investment. They expect something similar to happen in a SIP. In a SIP, it is no doubt clear that if you stay the long term, and long term really means 10 years, that if you continuously invest for 10 years, you have always in the past got excellent results. But please remember that while those 10 years are happening, you are not going to see a fixed deposit like increment every year. Every year, in fact, there is bound to be losses. Forget about being an increment every year. As long as you keep your wits about you, as long as you keep investing when you have those losses, that is the time when your wealth is being created. And at the end of 10 years, every time in the past, you would have ended up making good returns. So I think the key is to stay the course and not decide after 1 year or 2 years that the SIP is not working. Is there some other way of investment?
Right. So, Mr. Roongta, not just returns because of the corpus that you get in the end of the 10-year period. There are some tax savings in particular kind of mutual funds, right? And for Prem Sai, should he put this 40,000 rupees in an equity mutual fund, what kind of corpus can he expect 10 years from now?
So, I think really speaking, if he puts money in an equity mutual fund regularly for 10 years, if he puts that 40,000 rupees regularly, I mean, he would have invested about 48 lakhs. Assuming he gets a return of 12%, I think the corpus will work out to close to 92 lakhs. At the end of 10 years, remember that it will be tax free. There won't be any tax on it. So I think that really is the kind of benefit that a SIP can give. Any tax benefit you get, part of this you would invest in an equity linked savings scheme. Any tax benefit you get is an additional cherry right on top of those returns.
Right. Mr. Roongta, you have assumed a 12% return annually. Now, has any study been done on the performance of SIPs over a 10-year period? Is there a band between which your returns could be? I mean, you could be very lucky to be at the higher end of the band, but you could also be unlucky having invested in an SIP plan that doesn't give you the best return possible.
Right. So, I mean, plenty of studies have been done, and I think every study shows these kind of returns. If you, for example, look at all possible 10-year SIPs in the Nifty, assume Nifty was a mutual fund, and if you were to invest for 10 years regularly, every year 10,000, every month 10,000 rupees for 120 months, the minimum return that you would have made was 6%. The average return is around 15%, and the maximum return is around 27%. So that sort of gives you a range, that 6% to 27% gives you a range, but typically more than 90% of those returns are double-digit returns. So really speaking, expecting a 12% return based on past performance is not altogether a wrong expectation. Just one thing, and which ties in with what we responded to Prem Sai. If you look at this data more closely, there are 2,801 possible 10-year SIPs that you could have done from 3rd November 95, which was the date on which Nifty was started, up till 31st December 2016. 2,801 SIPs could have been done. Out of that, only 39 SIPs, or about 1% SIPs, are where every SIP showed a positive increment, which means that there was no capital loss in those SIPs. That's just hardly 1% or 1.3%, which had no negative throughout the SIP period. The balance 98% would have had a capital loss at some point of time or not. 790, a whopping 790, roughly 28% of those SIPs had a capital loss after 60 SIPs had been put in. Out of the 120, half of them had got in, and forget a return. After 5 years, it still showed a capital loss. There are in fact about 5% SIPs that showed a loss in the 8th year. None of those SIPs, remember, at the end of 10 years had a loss. The minimum return, as we already saw, was 6%.
So you have to be a long-term. You have to be a long-term investor and be patient. We have with us our next caller. We have Mr. N.M. Prasad Naik joining us. Mr. Naik, go ahead, ask your question.
Hello, good morning, sir. Hello, sir.
Yes.
Sir, I would like to know that my age is 26 and I have recently joined in a government sector, and I have an annual package of 7 lakhs, sir. And I am thinking to start a mutual fund investment SIP through an amount of 20,000. And plus I would like to have a term insurance also. But I am a bit confused that for going a term insurance, at what amount should I opt for? I am not sure about that. And another one is, I would like to go for mutual funds which are giving a 12% return plus tax benefit. Would you suggest me any of them?
So, Mr. Naik, quickly, first of all, congratulations that as soon as you have started your career, you're looking to build a long-term corpus. So, that is an excellent thought process. Is anybody dependent on your income, Mr. Naik?
Nobody, sir. Since my father is also servicing government, so he is independent and I am independent, and I don't have anybody dependent now. So in future I may be getting married, so that may be considered as for my insurance point.
Okay. So I think one good rule of the thumb could be that, so typically if you don't have a dependent, you may not have an immediate need for term insurance. But if you're going to get married soon, then probably you will have that need for term insurance. Additionally, you need disability insurance. If you are disabled because of any critical illnesses, or you are disabled because of an accident, you need disability insurance. Today in the market, you get products that are term insurance cum critical illness products. One of the good products is ICICI Pru Smart Protect, that gives you term plan, 1 crore of term plan, which is roughly 15 times your annual salary. You should buy it for 30 years, 15 times your salary, roughly 1 crore. You will get 1 crore of term insurance, which means your family get paid 1 crore if in case of your death, plus 1 crore critical illness. So in case of those critical illnesses, you will get a lump sum of 1 crore that will enable you to replace your income. That costs you roughly about 2,500 rupees. You should look at an accidental disability. There is an Apollo personal accident policy which you can look at. That costs you about 1,000 rupees per month for 1 crore if you buy it for 1 crore. Plus, I'm sure you're covered for medical by the government, but please look at a super top-up policy of your own with a deductible, and that should cost you around 250 rupees. Please remember, insurance comes first before investment. Get your insurance covers in place. Get your pads on before you go out to bat. You must score runs, which is equivalent to investing, but please first have your pads put on. Insurance is like the pads that will protect you and let you stay in the match. So I think balance you can invest and a certain portion, so that would leave you with about roughly 16,000 rupees every month that you can invest partly in an equity linked savings scheme, maybe 10,000 rupees in an equity linked savings scheme, 6,000 rupees in a large cap scheme. On that, if you get 12% return, then I think that over 10 years, that SIP should give you about 37 lakhs. Please remember what we answered just to the earlier caller. This 12% return does not come year on year. It is not a fixed deposit. You are going to see considerable variations in your returns. In fact, you are going to see losses maybe as late as the 5th year, 6th year or 7th year. But in the past, if you have stuck to your guns, have continued making those investments, at the end of 10 years, you always make good returns.
All right. So stay patient, hold on for the longer term and stay invested in equities. We'll slip into a break. We'll come back with more queries.